Hey everyone, today I'm going to talk about self-directed IRAs and things that your custodian probably isn't telling you because quite frankly, they just want to sell something and they want your hard-earned money. So I'm going to talk about this mostly in the context of real estate, but this applies to a lot of different areas. So let's just start off with what a self-directed IRA is. First, an IRA in general is a retirement account. Typically, it's a traditional IRA, which means that when you make contributions, that's actually a tax deduction. In other words, the income that you're using to put into that IRA account is not taxable now, and any earnings within that account will grow tax-free until you withdraw them in retirement, at which point they become taxable at your ordinary rates. Now, there are also Roth IRAs, which are essentially the opposite, where you don't receive a tax deduction now, but they do grow tax-free, and then when you withdraw those funds, they are not taxable in retirement. A self-directed IRA, however, is one that instead of having a separate financial institution where you have usually limited options to invest, and it's usually equities or bonds or things like that, traditional ETFs, mutual funds, to invest in, a self-directed IRA instead allows you a much larger range of investments, which is why a lot of people find it attractive and why there's such a big market for it. However, there are a lot of pitfalls that you may not be aware of. The first thing I'm going to talk about is leverage, and that is when you use debt to acquire your investments. So typically you'll be doing this with real estate. If you invest in real estate through a self-directed IRA, if there's debt on it, then you probably have what's referred to as UBTI, or unrelated business taxable income. And essentially, on a very basic level, this means that income generated by using debt is now potentially subject to tax, which means this tax deferred account that you normally wouldn't owe tax on as you have earnings in it, now all of a sudden becomes taxable, which would defeat the entire purpose of doing it. Plus, it has more administrative burdens with filing to report that income. So a lot of times it's just not a good idea if you're going to invest in something that requires debt. The second thing that I'm going to talk about is depreciation. And depreciation, if you're investing in real estate, you probably already know, or at least hopefully you know, that depreciation is one of the biggest benefits you get for investing in real estate. And depreciation is essentially a deduction for the cost of the real property over time, even if the property isn't losing any value. And the IRS gives you those lives and tells you how long you depreciate them over, and you get that deduction even if the property goes up in value. Now, why this is bad for a self-directed IRA is because an IRA is a separate account from you. So you're over here with your tax issues, income deductions, everything, and the IRA is completely separate. So if you generate a lot of deductions and you have a tax loss on your investment, you can't use that to offset your other income. And that is a huge benefit in real estate. You're literally giving up one of the biggest benefits you have in real estate by putting it in an IRA. The third reason that I generally don't like self-directed IRAs for real estate is because you get preferential rates when you sell real estate. So a lot of you have already heard that you get capital gains when you sell real estate. Now, there is some depreciation recapture, which means to the extent you did take depreciation deductions, you may be paying a higher rate on that. But any appreciation over what you paid for the asset, that would have been capital gains, which is a much lower tax rate. This can be a 20% difference in the tax rate, which makes a big difference. Another huge benefit that you get from investing in real estate that you're giving up by investing in a self-directed IRA. The last item I'm going to talk about is some of the limitations involved in using a self-directed IRA. First, you can't do what is sometimes referred to as self-dealing. And this essentially means that you're part of the transaction with the IRA. So in other words, if you want to invest in a property and you plan to manage it yourself, that may not work because the rules say that you can't be related to that transaction. And by managing it, all of a sudden you're related. You can't guarantee debt most of the time because that could also be considered self-dealing. Another example of this could be if you were in the Airbnb business, and even though you had a third party managing it and maybe you didn't have any debt on it and you didn't guarantee any debt, Well, what if you decided you wanted to use the property for a little bit while it wasn't rented out? Well, you wouldn't be able to do that either. That also doesn't work because you can't have personal use of assets that are in your self-directed IRA. Now, I'm not saying that you should never use a self-directed IRA. There are definitely instances where it could be worth it. Maybe you don't get a lot of the benefits from the deductions because you're just a passive investor. And so you say, well, I'm not getting those now anyway, and so I'll give that up. Well, you still have to tackle the leverage issue and the capital gains issue, but at least you've solved one of the problems with them. But really, it's probably a better idea to use a self-directed IRA for other types of items. For instance, you might want to use it if you're investing in notes where there's interest income. So that would be ordinary anyway, and you don't get depreciation deductions for that. Or maybe you want to invest in other long-term collectibles or things like that you're not planning to sell for a very long time. Also, collectibles actually have a higher rate, even though it's still a capital gain property, and that could be 28% that you're paying. So the downside of having preferential rates can be greatly reduced when it's collectibles. Also, there's not any deductions for those like depreciation, so you're not losing out on that. And generally, you're not going to be acquiring those with debt. So those may be better assets to hold in a self-directed IRA. But generally speaking, as a general rule, you don't want to hold real estate in a self-directed IRA because essentially the IRS already gives you all these great benefits for real estate, and you are literally just throwing them all away when you put it in a self-directed IRA. So make sure before you open a self-directed IRA that you do your research and you find out all the negatives first, because a lot of the people that are selling these aren't necessarily telling you this. So I hope that's helpful, and I'll see you guys in the next video.